Hello everybody and welcome to another episode of Options Discovery on John Lothian News' The Spread. My name's Alex Teng, and just like many of you, I am no expert in the world of options. But with the help from some, we can learn more about options together. In this week's episode, we're going to be talking about the different asset classes that can underlie an option. We'll also be talking to Luuk Strijers, Chief Commercial Officer at Deribit, a digital currency asset exchange, to talk about what Deribit is, the future of options on digital currencies, as well as the future of industry regulation. So stay tuned for that interview. All right, so let's start talking about the basics of underlying assets and options. As we know, options are derivative instruments that are based upon some other security or asset. That asset is typically said to be the underlying asset of the option and is typically involved in the settlement of that option. A great example of this is an American call option on a stock. An American call option on a stock gives the buyer of that option the right to purchase 100 shares of that stock at the strike price before expiration. Now, stocks are not the only asset that an option can be based on. We also have bonds, commodities, indices, and currencies, which can all be used as an underlying asset for an options contract. It is also important to note that the underlying asset doesn't necessarily change the inherent nature of how an option works. See, an American call option is always going to give the buyer the right to purchase any specified size of that underlying asset at or before expiration at the strike price. But there are other things about the option that can change. From the units of underlying asset actually traded in a single options contract to the minimum price movement of the underlying asset, also known as the tick size, there are many different factors that can influence how the option behaves. Different underlying assets tend to behave in different ways, which influence how the options on those assets are traded. Now that we know about the stock or equity option, let's talk about the commodity option. How does that work? Well, commodity options are a little bit different than your traditional stock or equity option because it's not a bet on the underlying commodity itself, but on the futures of that commodity. So you're essentially making a bet on the price of the futures contract. A great example of this is the American style options on WTI, which is a product traded on the Intercontinental Exchange, commonly referred to as ICE. This specific contract is an option on 1,000 barrels of WTI, which is equal to a single ICE WTI futures contract. This means that if you bought a single call option on WTI and exercised it, you would then be left with a single ICE WTI futures contract, which is a 1,000 barrel futures position. If you would like to learn more about this contract, feel free to explore this page and more on ICE's website. Fixed income options, otherwise known as bond options, are very similar to commodity options in that for a lot of exchanges, the underlying asset of the option is not fixed income itself, but fixed income futures. A variety of fixed income futures are traded on multiple exchanges. The most common and liquid of these futures tends to be government debt. This could be anything from US Treasuries to the German Bund, Babel, and Schatz. The example we are using now is from the fixed income options portion of the Eurex website. Feel free to explore this page and the pages of other exchanges with fixed income options products to learn more. Another place where options are traded is in the currency market, otherwise known as the FX market. Options traded in the currency market are contracts where the buyer has the right to buy or sell a specified amount of currency at a specified exchange rate by expiration. Many FX options are traded in what are called over-the-counter deals. Now, over-the-counter deals are deals that are direct transactions between buyers and sellers and don't go through an intermediary like a public exchange. Over-the-counter contracts can be customized to fit the specific needs of the buyer, but are much less liquid and harder to sell. Options with currency exposure do exist within the public markets, but are very similar to bond and commodity options in that the option is based on the futures contract. One of the latest developments in the world of options have been options on digital currency. Now, whether or not you believe in the future of digital currency, it's undeniable to see that options on digital currency have been growing in volume. The most widely traded options in the digital currency market are European-style cash-settled options on Bitcoin and Ethereum. These options have a strike price that is based on the US dollar and tend to have a contract size of either 1 Bitcoin or 1 Ethereum. One of the exchanges that offers these digital currency options is Deribit. Luckily for us, we get to talk to the Chief Commercial Officer of Deribit, Luuk Strijers. Luuk Strijers is not just the Chief Commercial Officer of Deribit, but he is also a veteran in the derivatives industry, being head of product at SGX as well. So without further ado, please enjoy my interview with Luuk Strijers. Well, that was great. That was great. And so let's dig a little bit deeper into the product side because that's always very interesting. So I know you already kind of touched on it, but what are the different types of products that customers can trade on Deribit?
Yeah, so we as a platform, we've decided to focus on a few things which also come at the expense of others. So instead of a wide, let's say, supermarket, like some of the crypto platforms are, we are more niche and we focus on derivatives. So we don't have spot, for example, we don't have fiat on-ramping, we have derivatives trading. And within the derivative space, we have options, futures, and perpetuals. So perpetuals are essentially futures that never expire, so everlasting futures. Then we have the regular futures, just dated futures, June, September, December, etc. We have them ranging from weeks, months, and quarterlies up to a year out. We have the longest list of dated futures versus anyone else. And the reason is that we have options and market makers prefer to hedge using the direct hedge, as in if you trade June options, you prefer to hedge with June futures as well. So the range of futures is more elaborate. And then we have, and that's our biggest chunk, BTC and ETH options. And these products, all of them are so-called inverse options. That means that you deposit the asset to get exposure to the same asset, which is normal in the crypto space. So you deposit BTC, and using that BTC as margin or collateral, you can buy BTC options or sell them or whatever you prefer. So the price of an option would, for example, be 0.1 BTC. And that's payable from your BTC deposits, which sounds normal, but if you compare it to, let's say, Tesla, you get the uniqueness of it, because you typically pay Tesla options in dollars or in whatever currency you might have, but not in Tesla shares itself. And that's what we do. So our inverse setup allows you to buy and sell crypto assets using the same asset itself.
What is the typical profile of a customer on Deribit? And as you mentioned, you said institutional customers make up a majority of the order flow. So could you drill down a little bit deeper into why that is?
I think the reason is that the product is slightly more sophisticated than what our peers offer. So a standard product in the crypto derivatives trading would be the perpetual, and the perpetual is essentially a bet on one direction. So you buy it for short to medium term positioning because of some news you expect, because of charting, because of Twitter, because of whatever you believe in. And those, you either have the right direction 5 minutes later, an hour later, or you don't, but that's easy to explain. If you look at our product itself, it's more elaborate. If you open our screen, it's a typical options chain with the calls, puts, all the different expiries. You see all the Greeks. You see a screen filled with numbers, which scares off a lot of people. So in essence, a platform like ours is not suitable for the masses. It's suitable for more sophisticated investors. For that reason, we simply have lower numbers of retail activation and higher numbers of institutional, because in the institutional space, what we offer is exactly what people are looking for. So anyone that is used to trading any of the global traditional finance markets, they would need exactly what we offer. So fast, resilient, robust system showing exactly what you are shown in traditional systems as well. So our client base consists of those people that have migrated from their bank or whatever employer they previously had into a crypto focused firm, which could be a variety of firms. So we have a lot of market makers, the ones quoting on screen. If you look at the takers, it's a mix as well. So it could be miners, it could be exchanges, anyone that has the need to hedge their future income. It could be people with large crypto positions that want to hedge. It could be people like hedge funds that want to speculate on something they expect, upward or downward moves. It could be the interdealer brokers, so the firms like Genesis, GSR, Galaxy, etc., that have very large bilateral exposure and want to hedge their books. It's essentially the typical mix you would see on any options exchange, where a smaller component, in line with I think anywhere else except the US. The US might be a very retail active country, but if you look at, let's say, the Eurex client base or activity levels, it would be comparable. I think the same applies to Asia. It's very largely driven by institutional flow.
So another question I have, which kind of is along the lines of the same topic, is what is the pricing structure of the exchange? Are you guys a traditional maker-taker market, or is there another way that you guys like to do things?
It's mixed. We have maker-taker for the futures and perpetuals, and we have standard fees for options. All the fees are volume-driven, so the bigger active clients would pay less versus the lower activity levels. The only thing we charge is trading, so market data, connectivity, the colo setups, port fees, setup fees, all of that is free. So our model is purely transaction driven, and we don't charge on anything else, which is, I think, standard in the crypto space, but very unique in the traditional space. I know from my previous role that stuff like cross connects and servers and co-location is very expensive. The same applies to data, but for all of that, the stuff is free, which is kind of attractive for those people moving into crypto, because they can operate a profitable trading model without a lot of fixed fees, which they do have in the traditional space.
Yeah, that is definitely a big component in the traditional space, and it's interesting to see how crypto exchanges are operating a little bit different to that. And the model that Deribit has is almost like a hybrid approach between what works in the crypto space and what works in the traditional space. So I guess one of the big questions that I'll move into is just the question of regulation. And it seems like Deribit, has been very strict on a lot of these different policies and a little bit forward looking when it comes to what regulation might look like in the future. So I just kind of wanted to go over, what practices does Deribit engage in, to stay ahead of potential future regulation and to meet the demands of the regulatory environment today?
Yeah, so we've always been quite conservative. So we're never aggressively marketing, pushing people. You don't see our logo at large events, and especially very careful with retail, because we recognize the complexity of our product. So we've never had regulatory problems anywhere in the world. So typically there's warning letters and all kinds of stuff some countries publish. We've never been on any of those lists. The reason for that is simply the conservative approach, as well as the focus on quality. So after FTX, you saw a trend in, for example, proof reserves and in overall transparency, and I think we're renowned for that. So we are far from perfect, but we have a reputation of doing the right thing when it matters, at our own expense. We pay for problems ourselves, and we don't have clients paying for those. If there's problems, we always compensate. So we've built, I think, the best version of proof reserves, which shows in our case a daily snapshot of all liabilities and real-time access to all our wallets, so you can compare the full list of liabilities for everything. So not some aggregation like many others do, but we simply show the full list of liabilities. We show the wallets, so you can compare whether our wallets contain enough assets to cover these liabilities. We have just been rewarded #1 position in Hop Trail, which is a comparison index for this kind of stuff, and #1 position by Nick Carter's On the Brink. So we are, I think, recognized for doing that stuff. With regards to regulation, we've decided or announced to be filing for regulation in Dubai under VARA platform license, which the rules just got published a week ago. So we are in the preparation of filing or submitting our policies and procedures. And the idea would be to create a global, more hub and spoke model, where Dubai will be the core, and that we will have broker licenses in a variety of regions in the world, starting with Europe. So a European client would onboard a European entity. All the European rules would apply to this European entity and this European client, and the flow would be routed to a single order book in Dubai. If we then, let's say, launch a Brazilian or Australian or whatever other broker entity, people would onboard with that particular entity, but the rules of that country or part of the world would only apply to them. So in the overall crypto space, the rules deployed by the various regulators differ. Some are strict, perhaps overly strict, and we don't think those overly strict rules, which in the end is all perception, should be applied to global clients. A client in Thailand shouldn't be forced to abide by European standards if he lives in Thailand. The Thai rules should apply there, and the Brazilian rules should apply to the people in Brazil, etc. So that's our belief. One core in Dubai, where we'll have staff. We have multiple people running the company, and then broker flow routing into Dubai.
Interesting. And so I wanted to kind of talk about as well something that you mentioned earlier, which is the technology infrastructure at Deribit. So from an exchange perspective, obviously your technology stack is something that's really important. So can you kind of drill into that and just give us an overview of what is used at Deribit and what your structure is?
Yeah, so as mentioned, we have dedicated hardware, which is based in just outside of London, which is unique because most people are AWS hosted somewhere in the world. We have dedicated hardware. So on this hardware, we have an Erlang-based system. Erlang is Ericsson language, which is less often used programming language, but it's known in the telco business. But also, for example, WhatsApp uses Erlang, and Erlang is known for its modular model as well as robustness. So it always keeps going, and it's able to, in a very fast way, process many different messages from many different components or modules. So we decided to build the platform on that, and the way it works is there's a master node, and there's multiple nodes connecting clients to the platform, and it really depends on where you're based and how you connect. So we have nodes for the people that connect via the co-location, via the cables. We have a load balancer for people connecting over the internet, and the load balancer simply allocates your sessions to a relevant node. In the end, this setup results in so this let's say faster programming setup as well as dedicated hardware results in us being the fastest out there. The Block did a research a comparison some time ago, looking at round trips from the various exchanges, and I think we're also known for that. We can offer round trips between 1 and 2 milliseconds, which in the crypto space is like a race car, super speeds, and in the traditional space, they're looking at nanoseconds, and they would say we would be terribly slow. That's partially true. We are not designed from a latency perspective from day one, so there's still room for improvements, and we're implementing those. But the biggest differentiator between us and the traditional space is risk checks. In the traditional space, there are clearing houses involved, the clearing brokers that guarantee the trade. And for that reason, the exchange doesn't have to risk check every order because those are guaranteed. And for that reason, it can be processed immediately. For us, we take the risk. We are the full vertical. So we are the broker, the clearing house, the platform, and the custodian. We are everything. And for that reason, we need to risk check every order we process. And that simply takes time. So it's never apples and apples comparing traditional to crypto. But when you compare crypto to crypto or crypto derivatives to crypto derivatives, we are the fastest one out there. The system, as mentioned, is based in London. We have a real-time backup in Zurich. So disaster recovery, and should something terrible go wrong, we can continue trading from Zurich. However, without co-location, etc. So then we can only be reached over the internet.
All right, everybody. Thank you for watching this episode of Options Discovery. I hope you learned a little bit more about the different underlying assets that an option can be derived from. I also want to give a big thank you to Luuk Strijers for coming on the show and sharing his knowledge with all of us. All right, everybody, that is going to be it for today's episode. Hope you enjoyed, and I'll see you in the next one. Bye. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.